Last week, the Federal Reserve left rates unchanged and the BoE cut rates by 25 basis points, but with a more hawkish vote split. Last month, the ECB cut rates by 25 basis points as well, and Deluard said that more cuts were possible. I'm Fiona Cincotta at StoneX, and to break this down and take a closer look at rate differentials, I'm joined by Director of Global Macro Strategy, Vincent Deluard. Hi, thank you for joining me, Vincent.
Pleasure to be here.
So the Fed, the BoE and the RBA have relatively high rates compared to the ECB and the BoJ, for example. What do rate differentials mean for the currency markets right now?
Well, what they mean, especially between the US and Eurozone, is somewhat diverging economic paths when it comes to inflation and growth. We got into the year worrying about a US recession, especially after the Liberation Day announcements. And a lot of these fears are receding. And with these fears receding, the market has to reprice the front end of the curve. We saw that last week. And I don't think that process is fully over. Jay Powell mentioned that there is a scenario where there's no rate cut in the US. And from the real-time indicators that I track, which are mostly tax collections, the open table dinner reservation, all this kind of anecdotal stuff, it seems that the big economic hit is not coming. On the other hand, the Eurozone has a pretty much clear path ahead. Inflation is basically at target, in some markets even below. If you look at kind of core measures, it's really eased a lot. So they have room to cut. And then for the other central banks you mentioned, kind of the Anglo world, it's a bit in the middle, right? It's always like that, right? The BoE is always kind of halfway between the ECB and the US.
And then, let's taking a closer look at the US dollar and treasuries. Treasuries are falling. The US dollar has recovered to a monthly high following these trade talks between the US and China at the weekend. What's happening here? And do you think this was really a major trade turning point?
What's happening is, again, the growth trade, the realization that US growth is going to be better than people feared. And if you expect better growth, you want a higher currency, you want higher bond yields. So that means that treasury prices go down and the currency appreciates. There's an additional concern when it comes to treasury market in the US is really the supply issue, which is probably more US specific. We have this somewhat artificial ceiling on issuance as we cannot agree on the debt ceiling. But we know that at the latest July, we'll have an agreement and we'll have to issue close to $500 billion in debt. So that's kind of that overhang is weighing on the market almost. It's not just about monetary policy expectation. The front end of the curve it is, but immediately if you go past 1 or 2 years, it's about, okay, where are we going to sell this debt? At what point of the curve? And then who's going to buy it? And I think that's what's pushing yields high in the US in addition to this kind of positive growth outlook. The second part of the question was about whether it's a turning point for the currency market, right? Whether we've seen the end of this weak dollar, I guess, was your idea. I wouldn't rush to conclusions. Obviously, these tariff negotiation, it's a bit chaotic. Today, it looks like appeasement. Tomorrow, it might be something else. We came into the year with a massively overvalued dollar. And yes, we had a rapid move, but we're pretty much back where we were 6 months ago, almost at 150 on the yen, 110 on the euro. So there is still room for the trade, the weak dollar trade to go, especially if, as I believe, it's driven by institutional portfolio rebalancing away from the US and capital repatriation. The movement has barely started, in my opinion.
Excellent. And then I guess finally, do you see a situation where US dollar dominance could fade?
With everything, it's about time horizon. So without specifying, yes, at some point, we all die. Global superpowers change. Fiat currencies get destroyed. So if you ask me, if you give me a millennium, yes. In the short term, if your question is about dominance, the relative share of the dollar, yes, it can keep falling. but I don't think we are this, kind of end of the dollar. I mean, this is basically what Besson said. We want a strong dollar doesn't mean a dollar that goes up all the time. It means a dollar that is used in international trade, pricing commodities, reserves, but it doesn't go up all the time. I mean, obviously, otherwise the world economy would break. I mean, we had several periods where we had 50% plus decline in the value of the dollar in the 70s, in the early 2000s as well, and then people still trading dollar. And I think that's very much aligned with what the U.S. administration wants. It wants the world to use dollar. It just doesn't want It just doesn't want the dollar to be so overvalued that we cannot export. So. And I think that's very positive for global growth. The strong dollar was choking global growth, and in a way, nature is healing. The currency market is doing exactly what it should do, which is rebalance consumption flows. We had overconsumption in the US, underconsumption in Asia, and underinvestment in Europe. What the weak dollar does is that it addresses all these concerns at the same time.
Excellent. Well, thank you very much for your analysis, Vincent. Great to catch up again.
Always a pleasure.
Thank you. For more videos like this, please do like and subscribe.